Yeah.
Right.
It's fine, it's good. Yesterday was nice outside there too.
Banshees of Inisherin.
Just
Yeah, so.
designed by the same guy that designed.
So yeah.
That sounds, he likes flats.
He loves that.
They don't have
Yeah.
the movie.
Oh, okay.
Yeah.
Have you ever
The
watched
ones
Flats of
longer.
Water?
Right.
That's all right.
But
Oh my God, all new.
It was shot.
Of course not, right?
I do like this the way.
Mine feels like it may have been, some of it was shot on.
Yeah.
One of the other eye. Not right.
So good feel. Yeah. All right, we'll talk to some, yeah, I need more members.
I wasn't, no.
Yeah.
Crossing the meeting.
I imagine they're showing like super.
I like the dance
I understand. Get critical mass and people are gonna be more serious when they interact with you.
Well, that's the other, that's the thing we don't see with these doing not to put down more number requirements. You have to do some basic,
You spend time elsewhere.
basic screening.
Most of my time is
Who's
done.
saying? Because you're sitting
Makes
there.
sense.
The other guy?
Okay.
Yeah.
And I've actually never been called.
Super smart.
And
And
when
he
you talk to him,
knows,
wow, you really know this subject.
he knows it. So,
Fly in and
and
out.
so ultimately, what we go is have kind of like leads for,
The slide looks okay.
we come to level of, and I'd like to have leads for
Connemara.
then revolve them, so it's in the screen, then
Because they're here
leads
stuff.
Yeah.
in your area, so you come to you.
But we did.
There's still a those things. So we can, we're textual,
Yeah.
five leads.
We did it.
Who's coming to the other challenge.
With Seamus, Seamus carried, he did all of the arrangements with all the B&Bs.
So I have to find another way to screen.
I would personally not up more about it.
No, not under that. I mean, the meeting will still have three, but it's kind of seeding us. And maybe, I'm a fan of it.
To be like,
So I do it.
it's like, right? Right, right.
Yeah, great to have you here.
Right.
Way we found this.
Yeah. Also coming and everybody else.
Hi there.
So you want to see that?
I think we should sit down, yeah, you wanna use the
With
order
the
that's above you.
sequence.
So I'm gonna take this.
Oh, wait, so that's sequence or a sequence?
We'll match up, so I'm on the end here.
These are
Yeah.
inverse.
Yeah.
Yeah, so.
Yeah, I got it. I'll show you.
Yeah, on the other side.
Okay.
Yeah.
No, I'm good, right?
Yeah, I think we should actually.
No, it's not that large.
Okay. How about advice here?
Do you mind scooting that? Oh, you're so I'm not in the hallway.
Why don't you want to be in the hallway?
And I'll be fine.
Yeah, exactly.
You know, I considered it, I was forced into doing that, so.
I got so tired of it.
I know, my team hates that, they're all labs, insisted, insisted I work on it. But to show up as myself.
It really does. I sent you something yesterday.
I saw that, thank you.
Yeah, no, they really hate it.
She was super simple. Wow. I wish she was in Connecticut because I want to help with Connecticut against that. You gotta help me penetrate all those doors. She's so.
Yeah, Colin is from the northwest corner.
Every time I see those stickers with cars, I can also know.
Read up.
I was, yeah.
Yeah, so I might.
I still
So
have
you
that.
were at dinner together?
No, she was like,
We've never seen any, I had signed up originally and then I had.
I really.
I started working and so I don't know that it's taken up there.
it's just really like
I've done that, I don't get a word.
let's get together, let's have, I'm like, how's I'm like, what in the
You
world?
have a watch on.
Alright, everybody look over at me. I don't know if it's gonna look good, but we're gonna go.
No, I make sure.
One more try, guys.
One more time.
You know what's so funny? When I do that,
Yeah.
I'm panicked about putting my, even though I never really thought about it before, I'm panicked about putting my hand over the screen as if that's part of me. Like, I go to great lengths to do that, and I'm like,
And you know it's digital, so you can
but
do
it's
it,
so
if you can do it over.
funny. I know, I'm always like, no, you can't do that.
This young one is like, look at these little people.
I know, I'm not like that. I'm not like that. I know all the way the prices were.
I gotta yell that, not in freedom. Detours.
I used to volunteer 10 years ago. I started helping retirees sort of learn how to do photography, primarily because they have
Yeah.
close by, whatever. It's just like, many times I have to explain it. So if you put your hand on the lens, the picture's not gonna come out. It's just like
So this is my now 7-year-old granddaughter. Her first open face. She was picture, she was 8 months old. But I was showing her the picture. She said, you know, you can make that your own. She showed me, so she.
those that used to be. We should be better. Just be like, wow, great. I'm part of that.
Want to join us? We have an extra chair.
All right, let's do it. Good morning, everyone. Thanks for waking up early and getting here on time. And I'm sure there'll be some other people who will wander in, but I just wanted to kick things off. I'm really proud to be here at Yale. My name is Danielle Cohn, and I'm the founding partner of the Wave Ventures, and based in New Jersey, Philadelphia area. Before this, I was the head of Lift Labs at Comcast NBC Universal, and built and ran that program, which invested in about 100 seed stage companies and some later stage companies. That's a little bit about me. I am going to do a quick overview of the panel today, and we're going to get started because we have lots to talk about and lots to say. And I'm sure we also want to make sure there's time at the end for questions. So again, thanks for being here. To my left, Marty Isaac, and Marty is president and managing director of the Angel Investor Forum, Connecticut's leading angel investor organization. He also co-manages the Northeast Syndication Network for the Angel Capital Association. Before that, spent 20 years in senior marketing product roles at large consumer services companies specializing in subscription services. He's an investor with over 140 companies in his portfolio, including Calm, Loom, Coinbase, which I think I own all of those, as well as Hustle Up and Nagish, which were actually part of the Lift Labs program. And so I'm not a direct investor in those, but made the investments in those, and is a graduate of Wharton at, of course, in Philadelphia also. And the next person is Chris Gelnaw, right? Gelnaw. And Chris is the managing partner at Tidal River Fund, a new fund associated with Tidal River, a network of angel investors supported by Allison Malloy of Connecticut Innovations and Annie Lamont. And the fund's mission is to get more accredited women in Connecticut active in angel investing opportunities. And her professional background is centered on innovation and spans industries from banking to consulting to market research to entrepreneurship, as a member of 2 founding teams at 2 startups and a leader in an accelerator program, and made your first investment last night in your new fund. So you'll see that some of the theme today is we want to make sure you know about all the resources if you're thinking of becoming an angel that you can start to get involved with. Next up is Marie Rocha. Did I say it right?
Yeah,
okay, awesome. And she founded Realist Ventures, a venture fund based in Connecticut, funding early stage biotech and software startups. She's got 20 plus years of experience in business and tech as a software engineer and serial entrepreneur. Her first startup was a candidates matching platform for staffing agencies, and then she later co-founded a sustainability e-commerce store, followed by IMEX Software, a startup building software and platforms for small businesses and nonprofits. And Marie founded Realist Lab, a tech incubator to support entrepreneurs seeking help with funding, technology, and very practical tools to scale their businesses. As a champion for women, and we got lots of champions for women up here, she's one of Haven Hatch's founders, a quarterly women-centric pitch event to support women founders seeking funding, exposure, marketing, and growth. As a reminder, it is still only, actually it's gone down since I started working in this space. Used to be 2.2% of all VC funding in the US went to women, and it's now below 2%, sadly. And I'll keep saying that, sadly. And then last but not least, Rob. And I'm gonna go back to my piece of paper, sorry. Rob Bettigole is a managing partner at Elm Street Ventures, a seed and early stage venture capital fund he founded with Yale as lead investor in 2006. Rob was an engineering major at Yale, received his MPPM from the Yale School of Organization, where he's a part-time lecturer, and he sits on a number of portfolio company boards and serves on the board of BioConnecticut. Is that how it's pronounced here? BioCT. Mm-hmm. Awesome. All right, so thank you for spending your time here today. Great panel, excited. Maybe start with Rob. Is there anything else that I didn't mention on your bio that you want to point out in terms of what you focus on?
Yeah, I should, since I'm sort of the odd person out here, not being an angel investor. Although if you talk to the billion-dollar venture funds, they would say, well, you're so small, you're an angel investor. So Elm Street started in 2006. We're on our second fund. The fund is a $34 million, the one we're investing out of is a $34 million fund. Yale's our largest investor. We have a real focus on Yale spin-outs and Connecticut. 19 of our 32 companies to date have licenses or had licenses to Yale Technologies. And we largely have a life sciences focus, although we have done some software companies, non-Yale software companies, and two engineering materials spin-outs from the university. And we're very active very early on, so sometimes with and sometimes instead of angel investors. We've been co-founders of 8 or 9 of our ventures. We're one of our part-time venture partners, or my partner and I has taken a leadership role at the startup phase. So very hands-on with our companies, but I started in venture after attending School of Management at the old campus, not this fancy new building, but started in the venture business then 40 years ago, and still kind of think myself as a generalist. I think a lot of angel investors do also, with maybe some specialties, but just kind of traditional approach to investing, strong diligence, hands-on with companies, and investing for the long term.
Great. Marie, what would you like to talk about in terms of your, what is your thesis behind what you're doing?
I'm very much a generalist as well. We have the fund, but I also invest on my personal cash as an angel as well. I think I've done about 42 deals. I actually don't keep track of those things. After a while, if you're in venture, it's best to not keep track of your deals.
We don't count the losers.
Not even. I just don't. I'm an LP in some funds. It's just such a mixed bag, and sometimes I just forget because there's the fund and then there's the angel I also run an incubator where we build MVPs for founders, and so like there's that portfolio. So it's best to not try. But I will say, if you follow the bio, I'm a problem solver, so everything I've done has been around that. I sold my first company at 19, not because I knew what I was doing, but it was because I hated the paperwork of stuff in agencies. If you worked at one back in the 90s, you sort of like scan the resume barely, because yeah, and it was like that process didn't work, and I was just like, there's gotta be a better way, and that's kind of how I got into entrepreneurship. So because of that, I can be a little more empathetic to founders, and I think that's been the key to my founder journey. And I say this because I hang out with more founders than I do with venture or investors, because they are like great at deal. I was just thinking about this question yesterday. That's where I get most of my deals. Even when I say no, they're out there scouting, they're at different environments, and I've co-invested with some of them. So you know, if you like any of that and want to hear more, that's my spiel.
Chris?
Like Marie, innovation is like runs through my veins, I think all of us, right? And so we're all passionate about it. We're all passionate about helping people get better at cultivating their ideas. And so I've been in the space for a long time, and we created this. We're Allison Malloy from Connecticut Innovations, and Annie Lamont who's like a badass venture capitalist herself, and the governor's wife. They were in a room one day, and it was a bunch of male investors, and the two of them were like, we need more women in this room. And so they created this group called Tidal River, and it was a network to get accredited investors investing in companies. And what we found was that all these women, amazing women, accredited investors, were hesitant to write their first check. And so we decided that we were going to create this fund. It's our first fund. It's almost the same size as Bob's, $500,000. So we're making investments of $50,000 in the next 2 years in diverse founded teams. And as Danielle mentioned, we made our first investment yesterday. But we got, immediately, we got 25 women like signed up. I want this. I want a diversified portfolio. I want, to invest in industry agnostic companies that have diverse founding teams and or a social mission. So that's really exciting for us, and that's really what we're all about is helping women get on cap tables, but also helping diverse founded teams get funding.
Great. Good morning, everyone. My name is Marty Isaac. I'm with Angel Investor Forum. I'm just curious, how many people have ever heard of Angel Investor Forum? That is much better than I was expecting, because I kind of feel like it's this big secret within Connecticut, and there's so many people that like to invest that are maybe casual angel investors. I hear so many people have said, are you an angel investor? And I'm like, well, yeah, I gave my buddy starting a company, I gave him $100,000, $200,000, and I'm an angel investor. I'm like, okay. That's kind of one way of doing it. But our group has been around for around 20 years. I've been involved with the group for 5 years, and I took over management of it a year or so ago. In that time, we've just about doubled our membership. We're around 80 people now. We're looking to grow that to around 120 or so. And the reason for that is we make our decisions independently, but we rely on each other. So we have a great, smart room, a lot of different verticals represented, really smart room. We help each other. And the thing that's particularly nice about angel investing from my perspective is it's very cooperative. Even those with an order of magnitude more affluence than I have, I'm in 140 deals, by the way, but even those with significantly more wealth, they tend to invest $25,000, $50,000. So as we're doing investments in our group, we may put in, say, $300,000 to a deal. But it's rare that our group is ever going to fund. I think our high water mark is $1 million. It's rare that we're going to really take a full round. So we work cooperatively with many, many other angel groups. And to me, that's part of the fun, because as you go off into the higher rounds, C rounds, D rounds, it's often one VC firm, two VC firms, muscling their way and taking the whole thing. I wouldn't call it such a cooperative sharing environment. And this, to me, is just a huge amount of fun. I kind of got into this accidentally when I was semi-retired. I was one of those guys. A friend of mine was starting a business, so I gave way too much money for my level of affluence to this one deal. Fortunately, it did fine. But as I learned a little bit more, and I was fortunate in my career to be in some rocket ships that really took off, I'm like, how do you get on more cap tables? And as I began to understand this, there's a real opportunity to build some significant wealth as you get on more cap tables. So now I'm on 140 cap tables, and the numbers are beginning to work, and so it's been great fun.
Because all you need is one winner.
Well, one is nice, but, you know, I need a lot more than one, if you're in 140, yeah.
So that's really great. And you can see the breadth and diversity even of the types of investors up here. I'm going to jump actually right into this question because I think what you just said ties back to what we talked about on the call. We should just get that conversation out of the way. Went from a more institutional investor perspective, how do angels show up in good ways and not so great ways? For founders who are here who are thinking of going after angel investing, what's the perspective that later stage investors have on angels that they should be aware of from a founder perspective? And also, I'd say the same question, and anyone is welcome, maybe after you take the lead on this one. And then also, what should investors be aware of in that same situation?
Yeah, I think the overriding theme has got to be alignment of interests. So between founders who hopefully have a choice of the kind of investors they bring in. But I think you have to kind of look ahead to what are the capital needs going to be of the company. We're in a number of therapeutics companies, so we might end up with $3 million in a deal, but that might be out of $300 million that the company needs to get through their initial clinical trials. So what are the big institutional investors looking for? They're not looking for a cap table full of individual investors or small funds. I think the smaller funds are a little bit closer aligned because there's an expectation of investing over the long run. So you said you have $500,000, you can make 10 investments. It doesn't sound like there's a lot of money for follow-on. So pretty much every company they're going to be, from start to liquidity is going to be 7 years, sometimes quite a bit longer. And there will be dips in the economic cycles and there'll be problems. And so, for us as investors, we want to make sure that our co-investors understand that it's going to be a long process and have reserves to continue to support the company going forward. And I think that's also important for entrepreneurs. But it's just like anything. It's all down to the individual, angels or funds. There's terrible funds big funds I wouldn't want to invest in because the way they treat other people and throw their weight around. Kind of to your point about the sharp elbows. And there's some great angels that bring a lot to the table in terms of value add for the entrepreneurs. And there's a way it's important for founders to know how to manage collaboratively their investor group. So one of the things, if there aren't angels in the deal, we really look to see it kind of glued together. So there are not 20 people to go chase when you're in this urgent situation where you need shareholder approval and you've got to get people to sign off and they're off on vacation around the world or on a sailboat without a link to the world.
Other perspectives on
So,
the question?
I'm an angel investor in a lot of large deals, and I mean small check. Think $25,000 in a 100,000 million round, like Liquid Death, Athletic Greens, those kinds of companies. One way I've worked through that, or some of those ideologies as a small check, even from our fund, we raised $10 million. We returned some of it because our thesis didn't align with some of our LPs, and then my founder and I, we just powered through anyway. We just find value, we just add value to the founders, and so we're a sounding board, we leverage our network, I leverage my network, I show up for them, so there are times where they need me to just be there for a big sell meeting. I don't know anything about sales, but that's one way to add value. So to his point, yes, a larger check is more meaningful, but as someone who understands how hard it is for Chris to raise $500,000 to support women and minoritized founders, I'm encouraged by that, and I want more women to take those steps and more minoritized people in general. So I would say just like leverage what you have. I didn't know what to do here. I was just frustrated that there were no women, no Black founders getting funded. So I put up some of my cash. I had a little bit to do with that, and that's how I got into the space. So as we're thinking about this group, I'm assuming a lot of your potential angels or aspiring emerging fund managers, don't focus on like the things you can't handle. Like, yeah, I'm never gonna be AZ-16. That's okay. I'm just gonna be the small checks, and I'm so proud of it. Coming up with $10,000 is a lot of money. And so if you can start and leverage your experience, those are great ways to add value. I'm surprised sometimes at the founders who text me because they're way ahead than where I am, but they text because they're looking for a sounding board, or they've had a bad day, or their kid's applying to college. Like whatever that is you're good at, just lean into it. So that's kind of how I deal with my small checks. And to Chris, we met through our own founder hours through Haven, and build that community of people that you can share deals with, that can expose you to those deals. So that's kind of how I battle the more institutional, no offense, older school kind of approach to venture as I think about diversifying my portfolio.
But you are adding value, I mean, that's.
Well, yeah, but I just mean the money there's a lot of money that's not helpful, right? You can write a check and never hear from the investor, or they'll never make an introduction. They'll never show up for you. Or if you have a small check like I do, like we do, and we add a ton of value, I can tell you I have the numbers to everyone. I can put a financial model together for them. I can build their MVP for them if they need it. So find what you're good at and then leverage that to kind of fine-tune your skills.
So the in-kind that you're bringing to the table might even be worth a lot more than someone who's writing $100,000.
I have one company, $1,000 I put in, and I'm probably they're now at Series E, I think, and they're, on their way, but $1,000 is what I had, and but I do a lot to help them, so just leverage what you
Are
can.
you're writing your own checks and then you have the fund?
So I have the fund and I also invest personally.
How big's the fund again?
Well, we're raising our second fund, 40 million, and then the angel deals I write, it depends on my liquidity, but I think the most I've written is 50,000, and then I have, the average check is around 10 to 25.
And one more question on the fund. How many people are in the fund? And
so it's just me, my partner and I, we started, that's a whole other panel by myself. How difficult it was. She's Asian, and we dealt with, I'm in my 40s, and I hadn't dealt with this amount of racism and discrimination and all the stuff we dealt with, and she was just not willing to keep going. We're best friends, nothing now here. But yeah, it's really difficult, and you kind of have to power through. So we raised 10 million. We returned about 4 million of it, to be honest, because those LPs were just not aligned. And I don't care about being a venture capitalist. I care about helping other people, leveraging my network, and doing all the things that I can do to help grow the ecosystem. So we were we don't need those people. And so we just kind of, I created the lab to do that. I invest my own money. And then now I'm I might as well just raise another fund, just because, I'm seeing a lot of people have changed their, impact investing and all of that. And I have the track record. So like a sucker, I'm gonna go back in there and then see what we can do. But generally speaking, you all know it's really difficult, especially as women. And as Danielle pointed out, it's so sad. Every quarter a report comes out, and you're just less women are getting funded. Oh wait, it just keeps getting worse. And so again, I encourage all of you to think about, if you're considering angel investing. Yeah, there are a lot of untapped and overlooked opportunities that are just looking for support.
And how many people here are already angels? And how many have you, I'm curious why you came today. Was it because you're a founder trying to connect with angels, or are there founders in the room?
Yes.
And then how many of you are actually interested in becoming a first-time angel? So, okay, interesting mix. All right.
All the women are here too.
Yes. All right, I love this conversation. We could stay on that topic forever. I'm sure everybody's got more to say. What qualities, from a startup perspective, what do you look for in the founders that you are investing in?
Coachability.
Do you want to start?
Coachability. Any founder who has all the answers is not my founder. I'm not gonna work with them because you need somebody who's receptive to taking input from different sources and either dismissing it or incorporating it, but having opinions about it.
I think that's a good observation. There's nothing more important, particularly, I'm early stage, so I'm typically coming in, and our group is typically coming in with valuations of companies under $10 million. That's, we're 3 to 8 million typically. So much is going to happen to that company. It is all dependent on that founder. So we put in a fair amount of effort to really understand that. I think one of the trickier things that's happened over the last few years, I call it going to acting school, because a lot of founders go to accelerators and other places, and they come out and they can do a 3-minute pitch or a 5-minute pitch, and it's perfect. And I used to use that as a proxy for helping me understand the caliber of a CEO. And that really is no longer effective because everybody can do a perfect pitch. And you really need to kind of dig in and help understand what's their industry expertise, just are they a good thinker? Certainly no ethical lapse by any means. I don't set traps, but I'm very attuned to understanding that if there's anything there, and I don't invest in jerks either. So any of those, I'll let a couple things go that, and everyone's aware of the exceptions out there where companies have done great. But for me, life is just too short, and I won't deal with any of that. But the founder is clearly the most important element, and so we have a lot of conversations to really try to understand, do we really think they're capable of dealing with those curveballs as they come, and how are they going to deal with all these challenges? Because it's the most important criteria for success.
When you think, since we're at Yale at university, when you think about investing in student-run companies, I always was really intrigued by who does that, who doesn't, what's the perception. Maybe could you give a little bit of context on any super early stage investments you've made and what your perception is of investing in the technologies coming out of universities?
I can talk about, because we've backed some students, even though we have, an institutional fund. It's always about the people. Whether it's co-investors, not investing in jerks, but you find just outstanding people, and they can be any age and any level of experience. They need to be coachable. Well, they need to listen. So, example. Eli Luberoff, who was going to be here, I don't know that he's come to this summit, but he started a company when he was an undergrad here called Desmos. And some of you may have children, and if they're in 8th or 9th grade, they most likely have used Desmos. It started as a fancy graphic calculator that runs in any browser. He was just on this mission to improve math education. Sold, and just kind of grew with the business, listened to advice, but made the right decisions on his own. So far, we have some stock as a result of a transaction last year. So far, it's a 24x. Unfortunately, it was sort of an angel round. We were the only institution. It was a $100,000 investment. Just fantastic. Just an extraordinary person. And the other one was an SOM student. I teach a class, help with a class here called Startup Founders Practicum, where MBA students work on a startup for credit. So kind of a mentor through the class. And one of my students, Chen Chen, was teamed up with then the head of electrical engineering here and started a LED type company, display company. That's going great. Because we're very careful about conflict of interest, I immediately had to say, okay, we may invest in this guy, so I'm going to trade you for another student. But it's finding those extraordinary people at any age.
I'll give a contrasting point of view, and I've done a number of investments with folks coming straight out of school, but the challenge also is when that curveball does come, the opportunity cost to them is very real. And when their friend is making $200,000 at McKinsey or whatever it is, and they're struggling and life is getting hard, I think, I've experienced a number that just, they raise the flag a little early. It's just like, I gotta move on. I'm 25 now, I've been doing this for 4 years, it's super hard. And, I'm gonna move on. And I think founders that were maybe more experienced and had a little bit more backing that they could withstand more of that, they may have played longer and come out the other side. So I am a little nervous investing in students. I think it's a really challenging thing to do. There's certainly these great exceptions, but I'm more cautious when I'm evaluating those opportunities, particularly for places like here where they have so many wonderful opportunities. How long will they play the game for if things get tough?
I'll just add, yes to all of that, but I also feel like I wish there was a US fund that just did that at the university level, because like Clovia's here somewhere, she's a student, well, she's a graduate now, but she's a perfect example of someone who's like hustling, because she has the time, so she can make the incubators, she can do 2 incubators at once, she can leverage the professors, I think she has an IP through school, she's gotten all these support, and there are places like Yale where you have so much support that, I wish America would just set up these funds, just like go crack at problems. Like while you're young, you have no school. Like I have a ton of ideas, but I have college tuition, so I can't take those risks. But I wish there were more of it, but not to discourage anyone from that end. But it just does not really exist outside of Yale and some of these larger institutions that have the endowments to support these kinds of initiatives.
And to that point, I've worked with a company who was trying to raise. She's young. Great traction, great revenue, but no investor would touch her. You're too young, you don't have the same experience. So she went the debt route, and she's doing great. Yeah. So angel investing or any institutional investing doesn't always work for every type of company.
I will say my biggest win is in a company called Loom, and which did remarkably well. And I was telling this story the other day. I did this entirely virtually. I never met in person. And I apparently never asked their ages either, because 5 years later, I finally took them out for sushi in New York because they're West Coast. Finally came over here, and in the middle of dinner, I said, you guys got to tell me just how old are you guys? And their head of tech, this is a couple years ago, the head of tech was 24, and the other was 26. It was 5 years later. I was like, oh my God, nothing like that, But it was a remarkable success story at the same time, so.
Kind of coming back to the coachability piece, so that there's another track which is worth for some students, I'd say, which is they recognize it's going to be hard to raise money. They recognize that they're going to make mistakes as they try to learn on the job, and so they recruit a CEO and hire one, which was a big success story here 20 years ago, managing funds for bursary offices at universities. 3 undergraduates, and they hired a guy who was CEO of the company, and they all 3 worked at the company for a while. They started to drift away. But Miles Lassiter stayed on and became CEO. So you're basically hiring your mentor and somebody who can help you raise money and build the business while you were learning on the job. And it's a great way to combine it and not avoid the burnout because it's going well.
We touched a little bit about red flags in the beginning, but what are some red flags that founders should be looking out for from any investor? What are the tentacles?
Without offending any man on this panel, on this room, on this planet, which I will, for sure. I think the language they use matters, because sometimes you need your investor to actually be your first customer and salesperson and advocate. And if they're talking about you as, I'm going to use this example, but they're like, oh, they're so young and they're so, like, that bias doesn't help you either, right? So that's one. An investor is unreachable. Okay, within 2 weeks limit, because sometimes my email is like that. But if you can't get in touch with them. If due diligence is weird, or they're asking you for, side letters that make no sense, or more equity than your valuation. All of that, they can be difficult. These are sometimes people who want to back out on your next round, or they're not willing to, again, advocate for you or give you feedback even, right? And so I have one deal, and I still regret it till this day. I didn't like the founder at all. But my partner at the time was like, she's great. I'm like, she's not. But we went in, and we were not aligned. Like, our values were not aligned. There were so many problems, and I also was not as interested. So even when she was raising, I'm like, whatever. Like, you know what I mean? And that's why you want to make sure whoever you're taking, I know it's easy to take money, but it's really not when you need them. And when things are going bad, like I'm the investor who, I get the call, and I don't need the report. I need to know way before the quarterly report that things are about to hit the fan. And you want that person who, if that's what you need. Now, I have some founders, I never hear from them. I just read the quarterly report and we're good to go. But really try and find mission-aligned people, especially when it comes to values, because that's really important.
Did you say red flag for the founders with the investor or investors with the?
Both.
I jump, but just, here's one little thing to watch for. If you get a term sheet and it requires that you as a founder have to pay for the due diligence when it closes, or there are sort of breakup fees or something, very bad sign.
Read your term sheets.
Yeah.
But I think, well, just to Marty's point, that he's not gonna invest in jerks, so don't take money from jerks either, because if they're gonna be a jerk from the start, that's gonna be the relationship down the road.
There's also a number of angel groups out there. It's definitely in the minority, but there's some big names out there that charge founders to present to an audience. I personally hate that model. And unfortunately, some folks get sucked into that, but and they're large. I mean, they do promise that they're going to give you an audience with all these other angels and what have you. But you know, as best you can, avoid that situation, because I think there's plenty of good groups out there that are always looking for great companies, and you shouldn't get stuck with something like that.
Are there any legitimate ones like that? I run away.
I'm not going to say their names here. I just came back from ACA, and there's a handful of organizations that do that. I'm not going to call them out. I just don't like the. There's three ways that these things tend to work. Either you have to make money some way. So in order for the organizations to exist, in our group, we charge a membership fee for the angels to join our group. It's not a lot of money. It's $1,200 a year, but that's how we're able to function. Other groups do the reverse, as I was saying. It's in the minority, but they charge the founders to present. Sometimes they also charge the angels. And then the third model is where they're taking a piece of the carry. The deal itself. So when I first was going, I was investing in syndicated models. I get access to deal flow, and they take 20% of my profit. I'm fine with those two models. I'm not fine with charging an entrepreneur.
Yeah, never pay to pitch,
Right.
or no, that's a huge red flag. Never pay for any of that. Or introductions.
Don't hire a banker to represent.
Oh, that too. Maybe
I've
don't take
never
an
seen it
investment from a banker too, but that's a whole other conversation.
The one other piece of the red flag I wanted to switch, because I'm actually talking to an entrepreneur group next week, but it's always an interesting conversation, that two things that can throw me off and our group off is if you're talking about an opportunity where the market is not sufficiently large to get a significant return, that's going to be a red flag on our side, number one. And then I think the other thing that's often surprising to entrepreneurs is the expectation of what we're looking for in a return. If you believe, when you really look at the marketplace overall, and the data says 50%, maybe as high as 70% of companies are not going to get back your original investment, and a significant percentage of that is going to go to zero. If that's the math, then what do you need to have happen to your winners? How high do they have to go up? So when we're investing, I'll just talk about me. When I'm investing, I'm looking for a minimum 20x type of return if everything goes right. I may do a 10x return if everything goes right, if I really love the company for some other reasons as well. But 20x return. And so when you talk to an entrepreneur, they're flipping out saying, you get 8% in the stock market, I'm going to give you three times your money back in 6 years. How can that not be fantastic? Because if that is my upside, all I'm doing is guaranteeing I'm going to lose my money. All I'm doing, because if 50% are going to zero and my upside is 3x, All I've done is just have fun, but lose all my money. So, we really, that's, I think, is one of the biggest things that maybe the founders aren't recognizing. It makes no sense. Why are you looking for such ridiculous returns? This is a guaranteed, I'm going to give you 3x, and the math just doesn't work.
Because it's all about the average of the.
Yeah, on my portfolio, I think I'm
Portfolio.
fortunate. I think I'm going to get somewhere between $4 and $5 back for every dollar put in, and that's on the high end of the spectrum because I've been lucky on some of my deals. And when you're in 140, some good things can happen. And I think I'll take luck as well. But yeah, if 50% are going to go to zero, you need to have that power law. Some of my biggest deals have given back over 200 times the investment. So that takes care of a lot of errors, but you need to give yourself that shot. And the thing that's interesting to me, I've been doing it for 10 years, I didn't know which ones were going to do that, right? Because every time you go into a deal, you're pretty excited about the deal, otherwise you wouldn't go into it. And so you can't look at the time and say, oh, well, this one, that I can live with a 3x because this one's going to go 200. It doesn't work that way.
Also on that point, make sure your numbers make sense and you can defend your numbers so that you're not showing this, 500x return. That is just not going to happen. So
It's a great point. I mean, in our group, we're particularly more interested in the cost buildup than we are in the revenue because revenue is so hard to project. I mean, you need to have a large enough market that if everything goes great, it can do well. And, a lot of things have to make sense to work. But you're right. From the math perspective and understanding, are you building an appropriate model? It's a lot on the cost buildup to try to kind of check their understanding of the business.
Okay, so we have 15 minutes left. I'm going to ask maybe one more question, then we'll go to Q&A. Can you share an example of a startup you invested in that you think has the potential to make a significant impact in the world, and then one that you think you missed the boat on?
I'm too early.
You're too early. Okay. Well, actually, maybe you could talk about what are the types of technologies that you are excited about,
So
even though you're agnostic.
Yeah, so we're really looking at something that's, got social impact. So the one investment we made is a billing company for medical practices that really helps the patient, because oftentimes the current billing process, they don't know they have a outstanding bill, and it goes to collections, and they still don't know. And so it can actually cause the patient to go into bankruptcy. And so this new technology really digitizes the whole billing process, provides the information immediately, and follows up not in the 30, 60, 90-day period, but in the 2-week time frame and earlier and more often, and provides information about payment options and terms. And so it really, it helps the patients and the practices. So we were excited about that.
Love that.
One company that I love, and they're, I don't know, maybe 24x for us so far. I'm still early, 4 years in, is Career Karma, just because I always get an email from someone who's like, I just landed a job making X, I was flipping burgers or something like that, which I love. As a technologist, I love more people to get in tech, so that's always interesting. And the painful miss, which, full disclosure, we're actually really close friends now. I was at her wedding last month, is Brasilia. I think I missed it because I was at Liquid. And at the time, and if you're an angel investor and you're just starting out, don't be afraid to ask for what the bottom is. So if you have a small check, I wish I'd asked because I could have put in even 25K, but I just figured then, she was raising several millions and my 25K wouldn't matter. And it was very early on. And it's Brasilia. The founder is incredible. We've become really close friends. We co-invest together, so it makes up for that a little bit. But every time I share her news, because I'm a fan, I use it for our nonprofit, and I'm a huge fan of what she's doing for nonprofits. But it always hurts. And Squire, booking startup for barbers. I think they started. I was like, are people going to barbershop that much? Now that I have short hair, every time I go, I'm like, oh! So Squire's another, and they're now a unicorn, and I could have put in a small check back then, or even through a fund, but I couldn't see the opportunity. So sometimes it's best to also lean in to your network. So as you're starting out, go to these pitches, meet other people who are ahead of you, kind of follow their lead a little bit in terms of mentoring. Ask for help. That's my biggest problem when I started out. I was afraid of being too new, so I didn't ask for help, which is silly. because there are so many deals I passed on because I didn't understand the market. I wasn't evaluating the proper way because I was just in my silo. And I'm more conservative than most angel investors, so like the numbers didn't make sense, the market size, but there are the companies that pivoted and did well. So lean on your network if you're thinking about angel investing, and just don't be shy. Oh, what's your lowest check you'll take? And a lot of people, especially these days, are so happy to like take in a small check if you're going to be the champion, the customer, the salesperson. I mean, initially that's kind of what you're doing as an angel.
Great tip.
So, kind of back to Marty's thing about being an early investor, kind of what you're saying. You just don't be so dogmatic as an investor and keep an open mind. So to the missed opportunity side. So I mentioned Desmos before. We invested $100,000. We did 2 smaller rounds, and I just always felt that the valuation was too high. He was fantastic. They were on the right track. They'd already knocked out Texas Instruments' wrapping calculator, the physical device. And so we should have followed on. Sure, it might have only been a 3 or 4x, but I mean, this was a company that was getting successful. But the big one here in New Haven is Biohaven. So we were a startup that we co-founded called Osmo Therapeutics. Two of our co-founders were the founders of Biohaven, which is this public, successful. And so at our early meetings, talking about this little startup that we were getting going, they said, hey, we're doing a round, and it's a $100 million valuation. So, we only do early stage, right? So I don't know what the market cap is now, 5-10 billion or something like that. So.
I'd say just real quickly on this, in terms, 17% or so of my investments have social impact associated with them. One of them that I was really excited about, I was actually the first investor in, they presented yesterday, is a company called Charisma, which is an internal heart pump. I had a very strange coincidence in that I was judging a competition when Mike was presenting, and he put the co-founder's name up on the board and had an odd spelling of his last name. And 2 weeks earlier, my brother-in-law literally had a heart transplant operation right here at Yale, which is unbelievable what he was able to do. But in any case, the doctor's name turned out to be this co-founder of this company, and he had invented a better device that my brother-in-law had been on an external heart pump literally for 3 months, and the danger he was facing was just absolutely enormous. And there's this new pump that Charisma has created that's going to save countless lives. And I love when there's an opportunity to have social impact and make a lot of money at the same time. So, I'd say 17% of my investments are in that. The one I missed was one of my early lucky ones, to your point. I had done a syndicate investment in Calm, the meditation app. And I had just gotten started. I put $5,000 in there. And then $5,000 literally turned to like $1.5 million. I mean, I'll probably never get a return like that ever again. But the thing that was interesting, probably a few months after I had done that, there was an opportunity to also invest in Headspace, I think is the competitor. I was like, well, I'm already in the market, why do that? Because it also was $1 billion company. So, I missed that opportunity. So there's definitely, listen, as you do this, you're going to win some and a bunch are going to go away. And that's just kind of life.
Mm-hmm. Love it. This was fantastic. We're going to open it up for some questions because we have 8 minutes. I'm always on time. Yes?
So previously there was a brief part of this where the discussion was basically about investing in students and essentially the pros and cons of that, and a large part of the con was the opportunity cost that's typically associated with that for students. But what I was wondering in particular was, what are your thoughts on students who study entrepreneurship as their major or master's or anything like that, where they may, while in school, be able to simultaneously get credit while working on their company as their main thing?
I'd say I did that too. When I fell in love with business in 10th grade, my dad was a superintendent of grade next schools. And I remember coming home and I said, Dad, you ever hear of a school called Wharton? He's like, yes, I've heard of a school called Wharton. But so I admire people that are studying that in school. It shows the enthusiasm they have for it. I wouldn't necessarily say that adds a huge plus or a negative to me. It really does come down to that individual and looking at that specific opportunity and try to understand just how, is it a significant opportunity, and is this student, do you really believe that they're going to go for it, and are they the right person to carry this out? So there's nothing, I think it's a positive for sure. It shows the enthusiasm for being involved in it. I wouldn't say I see any negatives associated with it.
I think a better way to ask my question might have been, do you see a difference in the opportunity cost when entrepreneurship is a major?
You know, I haven't really thought about it from that
It's
perspective.
the same thing. I mean, I actually love investing in young people because even if they don't make it, they have many, your second-time founder, fifth-time founder, eventually you get better at it. And so that's why I'm a fan of like universities investing in their students and like opening it up to angels. But it's the same. To me, it's the same. It's an experience thing sometimes, but also I only focus on a couple of things: market size, likability. I've passed on a lot of deals, and I don't care at this point. I'm like, oh, the IP, whatever. But mostly, if I don't like the founder, I can't do it. It's a long term. It's like marrying someone. You don't want to. So yeah, that's how I look at it.
And just on what I've seen too is like I like someone with a tech background even more. Someone who can actually build a tech and is building the tech and actually understands it, and even more than the entrepreneurship side. What's the next question? Did I see another hand?
Other questions?
No other questions?
I do have one.
Yeah.
It's more of a personal question, but as an entrepreneur, sometimes you make decisions that you're kind of, I don't want to say regret, but even as investors, so how do you like turn off and not obsess like compulsively about like when you miss a deal or when you make a bad investment or choose a bad manufacturer?
I think the whole marketplace right now of angels and VCs is full of that conversation right now as the market has imploded over the last 2 years in wondering, am I good at this? Am I making the right decision? Is the way I think about things right? And I think that's just natural. And you take your losses and you move on. And if you believe in what you're doing and your process and you continue with that, I think good things tend to happen. But there's always times, I think this time is particularly challenging for those that have been investing in companies that are 50 million to 300 million or higher, where they pay way too much money to buy into that company if they made that investment over the last 2 years. And it's a really challenging time for them. And I think a lot of people are wondering, what in the world was I thinking and how do I move forward?
Yeah, I don't live in regret. I'm like, it's so odd, but I don't regret anything. I don't envy anything. I'm like, oh, good for you, you made $1 billion. I don't really, and I think that's because I've been a founder for so long. I've had failures, I've had successes, but in the end, as an entrepreneur, it's so much better for you to just focus on the thing, like the future. So if you pay too much for something, move on. Like, I've done that, right? And in terms of deals saved, I remember Clubhouse was one. So I'm a very, I invest in unsexy businesses. I'm not like, oh, crypto, I don't do trends at all. So when everyone's doing Web3, I'm like, no. I did one Web3 and they're like killing it, but they pivoted into that because it helped them fundraise, but they're not really. But I don't follow trends, so for me it's a little easy to be stable. I didn't do it. I did one crypto through Republic or something, and I knew it was like, eh. So because of that, it helps. And as an entrepreneur, it's so much easier. I have this practice where I reset the day. So I don't go back to the mistakes from the day before, because as an investor and also someone who worked with so many founders, it's a lot to just carry all of it. So just reset your day every day. Every night, just reset your day and then start over.
And just on that same front, as an entrepreneur, you're gonna want to move forward, and you will have made mistakes, which may cause you to pivot. So you can't, again, live in regret. You have to live for the future and where the trends are taking you.
And why it's so important to have a strong personal board of directors and not get happy years along the way too. Be honest about what you're building and to actually listen. I think what I heard earlier, that coachability is really important. I think we have time for one last question.
I'm curious to know, when you think about the times when you have interviewed founders in the past, and there was one that you found very impressive that was sitting in front of you. What were the characteristics that you keyed in on?
For me, I'd say the complete, thorough understanding of their industry, every in and out of it, understanding the competitive layout relative to what's happening, and very thoughtful understanding of their go-to-market strategy, things that could go wrong, how they're gonna battle through, how they're building out their team. It's kind of a bunch of those elements that make it in there, but that type of thoughtful thinking exercise really impresses me. I'm looking at a company right now where the founder has this incredible track record of success. I think he's brought through 13 companies out, and all of them have been sold, like this remarkable track record, and what he's building now, he just knows it entirely. He has an A+ team associated with it, and it's just so impressive to watch somebody like that. It's like you want to bet on that person because they have a great history. They seem like they can do it again. They seem so motivated to do it again, and every aspect is exciting and promising.
And I love it, and we're going to wrap up with that, and I'm going to remind everybody to make sure if you are investing that you're looking at diverse founders.